Hello all, welcome to the second interactive video discussion between Macro Hive and LMAX Group. And this will also be the summary of the launch of the fourth report that we do together with Macro Hive. And we also thought this will be a good time to summarize what we've done in the first three reports as well. So maybe I'll start with a refresh on the background to LMAX and the evolution of the data team within LMAX. So LMAX is an institutional exchange with own matching engines in London, New York, Tokyo, and Singapore. We run central limit order books in all these locations. These are independent matching engines. And we also have an additional crypto matching engine order book in LD6 in London as well. So we have all the top banks and the non-bank market makers interacting with each other on the exchange. And the other interesting part of the LMAX ecosystem is that we have another division that provides liquidity to retail brokers. We provide liquidity, financing, leverage to retail brokers, and a lot of that flow aggregates into the main central limit order books. So this creates a very unique data set. From a data perspective, there are two key things that stand out for LMAX. The first is that it's a firm liquidity. So at any point in time, the data that comes out of LMAX is firm and executable. So there's no last look, there's no indication to the data that comes out. The other aspect is that we are a technology company, so we are in the ultra low latency space, which also means that we are able to provide up to a millisecond snapshot of the order books for your data consumption. Now, this combination of firm liquidity, executable price, together with the low latency and the high frequency nature of the data leads to, or rather led to a lot of clients coming to us and asking for data on a standalone basis without having to execute with the in the venues. So that's when I came in about 3 years back, and my background is before that I was 10 years at London Stock Exchange Group, and before that 8 years in Singapore doing derivative sales. So I lead all commercial data initiatives at LMAX. And we have been doing a year of partnership with Macro Hive, and we are looking at what interesting insights we can gather from the data that comes out of LMAX. With that, maybe I'll lead to an introduction to Bilal and Macro Hive.
Great, no, thanks a lot, Arun. So my name is Bilal Hafeez. I'm the CEO of Macro Hive. So Macro Hive essentially is an independent research and analytics company, and what we do is we try to look at the best data sources available and try to produce insights that are helpful to investors around the world. And our audience are typically the most sophisticated investors in the world. So we use, as I said, high frequency, low frequency data, so all sorts of data sets. Plus on top of that, we use the latest advances in statistical techniques, artificial intelligence, machine learning, and so on. So we try to always be at the cutting edge of what is available to investors. So that's a high-level introduction of Macro Hive. Let me hand over to Sam to allow him to give his background.
Yeah, thanks very much, Bilal. And nice to see everybody again 1 year on. My name's Sam Van de Schootbrugge. I'm a quantitative macro strategist at Macro Hive. I've been here for 6 years, and I look after a lot of our models. I have done most of the analysis in the last 4 reports, so you'll be hearing a lot more from me over this video.
Great, thank you, Sam. Thank you, Bilal. So maybe I'll start with Bilal. So the last time we were doing this, you reflected on your 25 years of experience, and you were talking about how the markets are kind of moving to a more quantitative space, and you spoke about how the advanced data-driven models are kind of outperforming the traditional approaches, right? So kind of broadly speaking. So what are your thoughts on that? I think what does this shift actually mean for institutional investors? And what do you think about the traditional ones? Do you think they'll kind of catch up? Where do you think we draw the line?
Well, I think today there's this expectation that everything needs to be validated and verified by data. There's much more of an expectation from institutional investors and their own clients that things should be as data-driven as possible. So where there's data available, it has to be used. So that's number one. So there's much more of a comfort and expectation around using data rather than purely personal or qualitative decisions. The other thing also is that as investors have become more sophisticated in their use of data, what we're finding is that investors are becoming more focused on the short term as well. So no longer is it acceptable to lose returns in the short run, nor is it permissible, so to speak, to execute poorly. And so this brings a much larger focus on the very short-term horizons. Now, in recent years, that's gone from hourly focus to minute focus, and the cutting edge now is really second and millisecond sort of focus, and that's where the alpha and also the alpha in terms of execution also comes in as well.
That's very interesting, and that kind of aligns very closely with what we have to offer here at LMAX. In terms of macro market themes, what would you, based on your discussions with your clients and partners, what would you say is the main theme that everyone is talking about?
Yeah, I would say at the moment, there's really three themes that dominate investors at the moment. Number one, AI. It's hard to escape AI in its various different guises. So at the moment, there's this big uncertainty around how robust this AI theme is. Mm-hmm. So a big story over the last year has been this CapEx boom that lots of hyperscalers are doing. Recently, there's concern around whether that CapEx will actually deliver the return. So lots of AI-linked companies are really starting to underperform. And at the same time, there's this thesis going out that AI will replace the function of lots of companies. So lots of software as a service companies, SaaS companies have really sort of struggled. So that's one big theme. And that's related to currencies insofar as there's been huge flows into US equities to capitalize on the AI theme. So if that AI theme starts to come under pressure, then those flows leave the US and the dollar comes under pressure. The other big theme is the so-called debasement, the US debasement trade, where there's increasing questions about the role of the US as a sort of central node in the global system. Lots of regions are trying to sort of gain more independence from the US system. There's questions around the fiscal policies, inflationary policies of the US and other sort of countries. And so there's this shift and move into gold as the best hedge against that type of dynamic. So we're seeing central banks around the world starting to increase allocation to gold, retail investors as well, and that's seeing gold really do quite well. So that's another sort of big theme. And then the final one, and it's hard to escape this, is US trade policy. So recently we had a Supreme Court ruling which essentially annulled President Trump's use of the so-called IEEPA Act to initiate tariffs. And so that means that President Trump now has to use other forms to impose tariffs. So this reintroduces tariff uncertainty back into the market, which then has an impact on the dollar and on emerging markets as well. So these are really the three big themes at the moment.
That's very interesting, and I think it's also quite interesting that we've touched on a lot of these themes in the reports that we've done over the last year, be it the Trump tariffs or the main theme on gold, especially because, as you might imagine, the last 5 months has been massive for gold and silver, including for LMAX. So what we'll do right now is start focusing on the fourth report which we are launching, and we'll kind of highlight some key insights that we've generated on that. Our focus on the fourth report is basically going back to what I mentioned on LMAX, is that we have 4 data centers. We have 4 independent matching engines where we facilitate the cross-asset marketplace. We have it in New York, London, Tokyo, and Singapore. So we are kind of looking at London, comparing London and Tokyo data centers. So the main aspect of what we are looking at is who are the market participants, what are the profiles, how they differ, what's the liquidity profile of the participants in London versus Tokyo. And really, is there any transaction cost or benefits that you can have, potentially savings that you can have by being physically in one of the data centers, or what you lose by not being in one of the data centers? So maybe to deep dive into that, I'll hand this over to Sam. Sam, I know we looked at 2 key events: the Bank of Japan decision in July 31st, 2024, and the Japan CPI 2025 in Feb. Can you just summarize the goal of the report, how we looked at the different themes, and what the conclusions are at a very high level?
Yes, thank you very much, Arun. So exceptionally interesting. We've written 4 reports over the year, and actually I think this was probably the most technical one that we produced. We used high frequency analysis, and the goal in essence was to run a horse race between what happened in Tokyo and what happened in London around these high impact, high volatility events. And so, as you mentioned, we use those two events in particular. So the Bank of Japan interest rate decision, where there was a shock to markets, and then Japanese CPI, where there was a large surprise. And so what we wanted to do was look at how volumes and how prices change on the different liquidity centers in response to that news. And because LMAX has this millisecond by millisecond data, it required a little bit more technical analysis than what we'd probably done before that. So just to summarize the methods that we used, and then we can go into the detail on the results. But what we did is we used three different points of analysis. So initially we used a reaction time detection method. So it's a volatility change point method, which looks at what millisecond level do we start to see a statistically significant change in the prices. So that's what we used initially. Then what we did is we used cross correlation to see how prices moved on the different exchanges. So what we did is we used the Hashida-Yoshida cross correlation method. And the reason why we had to use this very specific one is because if you look at times on different exchanges, they don't overlap perfectly. They don't, come through at the same millisecond level. And so what we needed was a method that could look at correlations in changes in prices at slightly different intervals. And then as the robustness checks, we went to our familiar normal correlation that everybody uses. And we stuck trades in a 10 millisecond bucket. And we said, okay, what happened at the different exchanges and how closely were they correlated?
Thank you, Sam. What is your observation? Let's start with speed, right? Because we've been talking about the ultra low latency of LMAX, the millisecond updates and stuff. What do you think about? What's your observation and conclusion on the speed between London and Tokyo for the two events?
Yep, exactly. So there were two really key points in this. So the change point detection method, what it showed was so we looked specifically at dollar yen and we looked at euro dollar, so very liquid FX markets. And what it showed is that the first statistically significant price move happened in the 20 to 30 millisecond level. So without ultra high frequency data, you're not able to see these first initial moves in the price. So that was number one. And number two, which was probably something that I didn't expect going into the analysis, was that actually prices move more quickly in London. So what we could show in the correlation analysis was London moved first, Tokyo moved after, and the difference was roughly 30 milliseconds. And that was, really, really interesting. And, without this type of data at an ultra high frequency level, we couldn't see that predictability. So what I want to try and say is the correlation was strong, but it wasn't just the correlation, it was the dynamics which were so clearly attached, which was, when we moved the data 30 milliseconds later and we tried to match them, which is what we did figure 2. So figure 2, what it shows is when we overlap the prices at the 30 millisecond level, there's a strong peak in the correlations. And what that means is, not only was there a strong correlation, but actually there was a the dynamic between the two was very closely aligned. And so we looked at how you could predict one with the other, because that's what's most important for investors. And what we showed is there was an 80% hit rate. If the movements in London went one particular way, within 30 milliseconds, the movements on the Tokyo exchange went exactly the same direction. We then tried different intervals. So we used 50 milliseconds, we used 0.1 of a second, and that predictability was no longer there. So that then fell apart. So, not only with this data were we able to show that there were high frequency moves, but there were predictable high frequency correlations that without it, we wouldn't have found.
That's great. Thanks, Sam. So predictive analysis, I think that's a big theme also in the markets for a lot of our clients. So from what you're saying, Sam, and from the report that I've gathered, London is mainly signals and Tokyo is more about substance, right? So in terms of the client profiles, can you elaborate a bit more on the potential savings that you can have? I mean, you did touch on the predictability from London to Tokyo with the correlations, but also like what does it actually mean in terms of dollar terms?
Yeah, exactly. So exactly to your point, there's a lot of price discovery in London, but that was only half the story of what we were talking about. The second half of the story was actually liquidity. And liquidity is obviously essential to get the best possible price. And so our next step in the analysis, what it was doing was looking at where most of the big orders were. So we anonymized the location of the trades. We lined up all the trades and we said, okay, where are the largest trades occurring? And time again, what it showed is that all the big players, all the large players, all the large transactions were all happening onshore. So they were all happening on the Tokyo exchange. So we saw that prices were happening first in London, but then we saw most of the liquidity was happening in Tokyo. So I think in the report, we specifically say that 88% of all large trades were occurring in Tokyo. And it shows that there's two very distinct players here. In London, what we have is smaller high-frequency traders who are trading these events offshore. And then locally, what we have is the big players. And the reason they do that, as to your point, with the cost saving, is because there's much more liquidity there. And so, what that means is there are much tighter spreads in those locations. What we show in table 5 is that trading dollar yen for these local events, the spreads are between 22 to 70% tighter trading onshore than trading in London. And in terms of cost saving, assuming 1 pip corresponds to $100 per $1 million traded, the cost of trading 500 million to 1 billion would cost roughly $45 to $90 million as a result of wider spreads in London. So there's a clear cost saving for large players to trade onshore. And that was something that was really unique to this data.
Great. Thank you, Sam. One of the other points that we also touched on in this report was the introduction of the NDF pricing that we have at LMAX. So from a liquidity perspective, we've always, in the last 2 to 3 years, we've been in the NDF market. But I think now the interesting part is we are now able to provide that as a data feed, and we are focusing on the Asian NDF. So do you have any thoughts on, the comparative moves in the Asian NDFs as an example?
Yeah, we looked at the Korean one. So we looked at the reaction time, and it was remarkable. Actually, it's remarkable to see the speed at which that one reacted as well, with not much of a lag to dollar yen. So the same analysis, the same conclusions still held in NDFs.
Excellent, thank you. I'm just going to bring in Bilal here. So we were discussing about the algorithmic nature of how clients can scale, right? Using that before requiring a human override. At what point do you think the future hybrid model of kind of investment governance, like how does it look like?
Well, I mean, I think this is kind of a big debate at the moment, especially when you start to deploy artificial intelligence to using these data sets, which these data sets lend themselves very well to using artificial intelligence, because AI, machine learning, work especially well with very large data sets. So when you move high frequency, millisecond data, then that's where really artificial intelligence does very, very well. The problem with artificial intelligence is that often it's a black box, so you don't actually know why it came up with its decision. So there needs to be some governance around that in terms of what types of models you use, what types of validation you use to see whether the signal was accurate or not. So there needs to be some kind of governance around the use of algorithms, i.e. you need to show how you tested it, when you're going to switch it off. The larger, more philosophical issue is that whenever you build some kind of algorithm, whether it's using statistical techniques, trading models, artificial intelligence, is to some extent you're assuming a certain regime is in play, because when you've done your back testing, it was over a certain type of market regime. The question then always is the market you're in today that same regime?
Right.
Will the model still work or not? And that's where humans come in, are very good at that. Humans are very good at pattern recognition, understanding where regimes shift, more so than models. And so that's where you kind of need this human override, where a person can often more quickly understand actually the world changed quite dramatically because of some political event or some other economic event, and then you start to reduce the influence of the algorithms. So that's at the high level, that's where the override really comes in. Below that, it's really more about transparency of what techniques you're using, under what circumstances would you reduce the risk, and so on.
Thanks, Bilal. And I think transparency is also key to what we do here, because the data that you get from LMAX is a direct access to source, and there's no normalizing. We don't do anything to the data, so you basically get direct access to source in that regard. So transparency is a key aspect of what we do. Now, over to Sam. We've done 3 reports so far with Macro Hive, and there are certain key aspects of each of these reports that have been a massive hit with a lot of our readers and our clients. So we'd just like to focus on some highlights of these reports. Right, the first one that we looked at was, the first report that we did was millisecond reactions to economic events, where the analyzed euro-dollar granular millisecond level, can it lead to any predictive analysis? And one of the key words that resonated with a lot of our clients was the critical thresholds chart that we looked at, right? This gives a lot of predictive power with the probability of the future moves in these currencies. So if you can just, if you can just throw some light on that, and potentially what could you lose by not actioning and waiting a bit longer on that?
Yes, of course. So a common theme throughout all of these reports is the importance of timeliness in data. And that's often best observed around key US data events because they generate so much volatility and price action. Roughly 70%, the volatility is roughly 70% higher on these key events than it is on non-event days. And that's why timely high-frequency data is really important, and it's hard to ignore these, especially in FX markets. So actually what we show is that around US CPI events, if you look at equities, only half of the total price action materializes within the first hour and 25% within the first minute. If you look at FX markets, nearly half of the total price action happens within 30 seconds. So a lot of price action happens within a very high frequency window. And so what we've tried to show in this report is we look at price changes of euro dollar, Aussie dollar, dollar yen, and dollar MEX at a millisecond level across CPI events, payrolls, Fed meetings, and so on between 2019 and 2024. And what that does is it gives us a very good sample of data. And when we have a lot of events, we can categorize them either as surprise events or consensus events. And what we specifically do is we look at surprise events because they give us much clearer predictive power over the direction of prices. And so what we do is we run a million simulations of what would happen to prices on different surprises. And what you're referring to is chart 6B. And what I was able to do from the distributions created from those simulations was say, if we hit these critical thresholds and we execute when they're achieved, you can get significant upside. So what I was able to show is, specifically, these thresholds were relevant to hawkish Fed events. If you hit that threshold, it's very likely we've had a hawkish outcome, and prices are going to follow that hawkish outcome. So specifically, if euro dollar prices fall 3 basis points in the first 50 milliseconds, we know there is a significant chance they're going to continue on that path and decline for the next 1 minute. And so you can capture around 95% of the subsequent price moves if you action that specific trigger threshold. And the reason that's important yes, you can go further out and you'll get greater certainty around whether it's a hawkish event or not, but you can lose out on the majority of the price action. So by just trading 1 to 2 seconds later, you lose out on roughly a third of the potential returns. So these critical thresholds are really important in giving you perspective on what scenario we're in and where the prices are subsequently going.
That's very interesting. Thank you. And do you see a similar trend in the crypto market as well? So the second report that we did was analyzing the crypto market and how it kind of moves from a price discovery perspective with the traditional FX markets like Euro and Dollar Yen and Aussie. So do you see a similar trend, and also to the fact that LMAX, when it comes to cryptos, not just the top of book, given that we are an institutional cross-asset marketplace, one of our key strengths is also the depth of order book that we have. So just want to hear your thoughts and summary of what we did in the second report and the comparison between the FX and the crypto market in this.
Yes, of course. So remarkably similar. And actually, it's funny because there was a paper done by the Fed, a working paper in 2023, which showed how important big key US macroeconomic events were for Bitcoin prices, which is exactly what we look at in the second report. But we don't do it at a 30-minute level, which is what they look at. We do it at the millisecond by millisecond level. And actually what we find is that price discovery in crypto markets is as efficient, and prices move, if not more, in cryptocurrency markets than in FX. And so a great example of this was charts 9 and 10 in report 2. And it showed that the equivalent magnitude of price moves in Bitcoin after the March 2024 Fed meeting were almost identical, if not more than the simulations that we ran in chart 5A in report 1 for euro dollar. So, we see time and time again that crypto prices move at the same time and at the same magnitude as euro dollar, but also directionality. They were very similar. So in both of the Fed events that we looked at, the correlation was 0.75 and 0.9 to the moves in euro dollar. And we can extrapolate that. So we were just talking about chart 6B, for example. If we know that we hit those critical thresholds and the market is signaling that price action for this is a hawkish outcome, then we know that also cryptocurrency is going to follow in the same way. We know Bitcoin prices are going to move in a very predictable, similar fashion. And so that's why it was very, very interesting to see the results in that. But as you mentioned, it's not just noise. And I think that's really important when it comes to cryptocurrency. I think what we were able to show with the LMAX Exchange data was real market depth. There were changes in liquidity beyond the top of the order book. And so, we were able to show there were deeper layers of trading activity that suggest that larger strategic players are active around Fed events. And, that is something that's really important because it helps us form expectations around future events as well.
That's great. Thank you. I think let's start summarizing the third report as well. That was very interesting because, as I mentioned before, LMAX has a business division that provides liquidity, financing, and leverage to a lot of retail brokers globally. And a lot of that flow aggregates into the main center limit order book. So we are able to provide at an aggregated, anonymized level. So you have an 8-hour aggregation. You can say in euro dollar, in the Tokyo Exchange or the New York or the London one, how much of flow in the last 8 hours in euro dollar is coming from the institutional side and how much is coming from the professional flow side of things. So this has, again, as I mentioned, seen a lot of interest, not just for trade monitoring back to middle use cases, but also for alpha generation use cases. So we did the similar analysis to see if we can gather some insights on the back of that. So can you explain, especially the one that we did on gold between Tokyo and London, if you can just expand a bit more on that?
Yes, definitely. And probably one of my favorite reports, actually. Really enjoyed looking at the data. the value of flow and positioning data, everybody's very well aware of it, especially in FX markets, where, typically there's a little less transparency than there are elsewhere. Individuals use it to determine exposure of market participants. They feed into strategies. And so, what I've tried to show in this data, in this report, is how to leverage the flow data. So either total flows, directional flows that were available, as you mentioned, flows into different data centers, the different types of flows by investors. So we look at all those different criteria. And actually, chart 1 right at the start is great context. It shows that there is so much information in flow data. What I do is I standardize the growth rates of flows in euro dollar over time. And you see time and time again, it's very, very predictable. Local peaks always occur around FOMC meetings. And then large swings are always related to geopolitical risks. So, you can see that there's predictable behavior in flows. And that's why institutional and professional investors enjoy looking at it. The gold story in particular, I thought was very unique. It's not something we've really had an opportunity to look at in the past. And yes, gold does, vary. The flows of gold do vary around FOMC meetings, but what chart 4 is able to highlight is the changes are much more deliberate and they're much more long-term. And these trends are very much linked to geopolitical risk. So I highlighted 2 in the chart, the de-dollarization of Russia and Chinese assets at the end of 2022, the pandemic. And so, you see very clear, very deliberate changes in long-term flows in gold. But what was very unique with the LMAX data is that we have directional flows. And so what I did is we could see that flows were very tightly related to how prices change. And so what I wanted to do was create a little sentiment score, which we could tie in together to see what the direction of the price moves might be. So that's what I do in chart 6. And I show that there's a tight connection between gold sentiment based on the directional flows and the daily changes in gold prices. And what is striking is, I show a considerable bullish bias. Everybody was long gold for a long period of time. There was considerable bullish bias throughout 2023 and 2024, which coincided with strong upward momentum in prices. And then actually later in the report, I take those models and I apply them not just to gold, but I apply them to other currency pairs. So I think right at the end of the report, I say, okay, in April 2025, the signals that I'm getting is go long in dollar yen and short in euro dollar. And actually, if you look at how that developed in May, it was spot on. So there's some very good information going from flows into sentiment and then into price moves subsequently.
I think it's been a theme across all the events that we've been to, right? Because flows were traditionally seen as smoke from fire, but now I think they've been predictors in their own right? They've been leading indicators of a lot of things. So I can just bring in Bilal here. So everything that we've analyzed, right? It involved analyzing a lot of data. Sam was talking about million iterations and so on and so forth. What is your overall high-level view on the adoption of, say, cloud? We've had a lot of clients say we don't want to have multiple instances of the data. If we can just work off the cloud, that'll be our best way forward. So things like Snowflake, AWS, which is where LMAX data sits, and also the ability to provide historic data for backtesting and coming up with these insights is very critical and crucial. So what are your thoughts on the adoption and the move towards from an on-prem into a cloud-based ecosystem?
I think a lot of it comes down to efficiency and flexibility. So once you move away from on-prem sort of servers and compute and towards the cloud, it gives you that flexibility to essentially ramp up your ability to digest data, to do back tests and so on, and then you can dial it back down as well. So when you're working very large volumes of data, you're never quite sure how much of that data you're going to end up using. You need some experimentation. So that means for that experimentation phase, you ramp up your needs. Cloud's very suitable, very good for that, so the variability. Then you can bring it all the way back down. So I think there's big advantages in moving into the cloud, number one. Number two, I think backtesting is essential, for the use of all of this data. So while you do receive the feeds real time, it's important to do some kind of backtesting in order to understand whether it can give you alpha signals or whether it's useful for execution purposes. And backtesting is really the best way to do that. And again, because we're dealing with very high frequency data, millisecond level data, that's very large data sets. So you need things like Snowflake, and it's easier to work in the cloud then in order to do these sorts of testing.
Thanks, Bilal. So in summary, I think we've noticed some key aspects, right? The first is we're able to analyze very granular data, both real time and the same granularity going back 10 years from an order book perspective, as well as intraday insights on the flow products. The ability to be able to analyze everything through the cloud and different systems, analytics and systems that you use. Any final thoughts from both of you? I'll start with Bilal.
Yeah, I mean, for me, I think this is just a validation of the argument that we're in a data-driven world, and the higher quality data you have, whether it's in terms of high frequency down to the millisecond level, whether it's in terms of the data showing firm prices rather than indicative sort of prices, all of these things really matter a lot. So the first thing is, all the analysis we've done show that if you're able to use this data, you can get an edge, whether it's in alpha or whether it's in execution. So this is a big sort of indication of that. Number two, I think it's very evident that there's an infrastructure element to all of this to make sure you're set up in the right way to be able to consume real-time data in a very efficient way, have the right infrastructure to do the backtesting as well. Mm-hmm. And then the third thing also is that it's a very dynamic market. Things are always changing. We're getting new asset classes, whether it's the crypto in recent years, and so you need to get hold of good quality data sources for that. And we live in a globalized world as well. So if you have venues in different parts of the world, Tokyo, London, New York, and so on, it's also important to understand that we're still in the globalized world, and understanding how you can use data from those different centers, how you can execute in those different centers can also be very, very important too.
Thanks, Bilal. Sam?
Yeah, from my side, it's been a great year. I think what we've been able to do with this data is stuff that traditionally we're not able to access. And we've been able to create interesting models, find predictable behaviors, and answer important questions that hopefully are insightful for investors. And this data has really unlocked that. So no, it's been great, and hopefully forward to some more interesting reports in future.
Excellent. Thank you both so much. So I think to summarize, we've seen how the LMAX data can be used across different workflows, right? So pre-trade, price discovery, execution-based use cases, middle to back office use cases, which is around valuations because it's firm liquidity, or if you want to look at the volumes that go through for a particular currency from a different venues, we have all of that information. So I hope you all enjoyed the summary of the past reports as well as the key findings from the fourth report that we have. You will have all the contact information in the email that follows through, but if you have any questions or if you want to discuss in further detail, please feel free to reach out to us, and hope you have a wonderful year ahead. Thank you all for listening in.